Hi everyone, Bill Lethman here for MoneyEvolution.com. In today's video, I'm going to be talking about why I think Ken Fisher is wrong when it comes to annuities. So if you've been on the business channel for a day or so, chances are you probably have seen one of these Ken Fisher ads where he's talking about how much he hates annuities and how he'd rather die and go to hell before he'd ever recommend an annuity to somebody. So in this video today, I'm going to talk a little bit about some of the reasons that Ken Fisher might not like annuities and some things that I actually probably agree with him on. But I'm also going to talk about a couple of things that I believe he's maybe too quickly discounting annuities and how they fit into somebody's overall retirement planning situation. So here recently I went to Ken Fisher's website, to his blog, and I went through that and I downloaded every single article that I could find where Ken Fisher was talking about annuities. I also downloaded his Annuity Insights Guide, and in reading through all of that material I found a couple of common themes for some of the reasons that Ken Fisher doesn't like annuities. So first of all, one of those reasons are fees, and I totally agree. I think some annuities have very high fees, but what we always want to make sure that we understand is if we're paying these fees, what are we getting in return? So some of these fees are actually for withdrawal benefits or income benefits that are guaranteed income or predictable income streams for somebody's entire lifetime. And annuities are really the only investment that exists where it can provide that predictable stream of income over an entire lifetime. Other investments can't necessarily do that. So it's important to understand where those fees come in and make sure that you're not overpaying. Also too, there's some annuities that don't have any fees attached to them. So it's important to understand before getting into any annuity what those fees are and making sure that you're getting some benefits. So there's one point that I definitely agree with Ken on, making sure that you understand those fees. Number two is he talks about how annuities are complicated, and I believe that too. I think that certain annuities can be a little bit more complicated, but that doesn't necessarily mean that they're bad investments. We just need to understand those a little bit more, maybe take a little bit more time with that, because the complications come in and some of the guarantees that these annuities provide and how they're going to provide maybe that lifetime income. So just because something's complicated doesn't necessarily mean that it's bad. He also talks about the tax advantages, or what he talks about is be careful because some of those tax advantages that you might be buying this annuity for maybe just don't really exist. And we agree with them too. In fact, we've talked about this in our other videos. Annuities, if you have those in a non-retirement account, generally you're going to take your gains out first and you're going to pay that at your ordinary income tax rate, which is your highest level of tax. And in that type of account, a non-retirement account, other forms of income like long-term capital gains or qualified dividends might actually be a lower tax bracket. So you want to look at that. You want to make sure you understand what the tax benefits or disadvantages are before getting into an annuity. So there's one again, not necessarily as bad, just make sure that you understand that. Now, a couple of things that I kind of disagree with Ken Fisher about is he talks about annuities and he talks about the two phases of an annuity. One is the accumulation phase, and then the other phase is the annuitization phase. And I think that gets to be a little bit misleading, at least with the way that I read some of the material, because he talks about once you annuitize an annuity, then you really give up all control, and depending on what elections you made with that annuitization, you might be just handing that money over to the annuity company, and if you die early, they get to keep all of your money. And that's 100% true with annuitization, but very rarely are we using annuitization within these annuities. If you're looking for that predictable stream of income, more often this is achieved by using a withdrawal benefit or an income benefit. Again, that might come with an additional rider fee and everything, but that leaves you with the control of the money as opposed to having to annuitize that money and giving up all the control. So he was, I think, a little bit misleading with the way that he worded that with the annuitization. Probably the biggest thing that I disagree with Ken Fisher on is that, well, I guess disagree and agree, because he uses over and over again in his literature how an annuity is not going to compare to the stock market. And he's got all these features where he's talking about the growth of annuities and how that compares to the S&P 500 and how it just doesn't stack up. And I 100% agree with that, because annuities are not going to get the return that you're going to get in the stock market. And I even hear other people that are promoting annuities. I heard an ad on the radio here not too long ago where somebody was talking about how you can participate in the stock market without any of the risk. And I knew that he was probably talking about an annuity with that advertisement, but I think it does get a little bit misleading. So with Ken's materials where he's talking about how an annuity isn't going to keep up with the stock market, we agree with that. But where we think annuities fit in is not as a replacement for stocks, but as a replacement for bonds or for the other fixed income pieces of your portfolio. So if we think traditionally what we want, if we're thinking, let's say a 60-40 retirement portfolio where 60% of your money is in stocks and 40% of your money might be in bonds or fixed income, maybe using a part of that 40% that would be in that bond category and using that as an income replacement. And then we can do two things with that annuity potentially. One is maybe reduce the amount of risk. Certain annuities have great principal protection. Not all annuities have that, but you want to make sure that you find one that does. And then find one that has some type of an income or withdrawal benefit. And those incomes can be guaranteed for your lifetime or for the lifetime of you and your spouse if you're married. And again, it's one of the very few investments out there that can provide that level of stable, predictable income over an entire lifetime. So again, that's where I think Ken Fisher is wrong, is comparing those to the stock market. And again, just to kind of wrap up, he talks a little bit about how there's nothing that you can do with an annuity that you can't do better someplace else. And again, going back to that predictable income stream, I think that's one area that an annuity definitely has an advantage over most other types of investments, all other types of investments as far as I'm concerned, where you can have that predictable income stream. Balanced portfolio of stocks and bonds in retirement. We can manage the risk, but it's almost going to be impossible to be able to guarantee an income stream out of a regular portfolio without using an annuity. So anyway, I hope that video has been helpful because again, I think when you're watching, whether it's an advertisement or you're reading a book or you're reading some material, it's always important to make sure you understand both sides of things and make a very well informed decision. So this video is part of an entire series that I'm doing all about annuities. In the description below the video, you should have links to all the other videos in the series there. And if you like what we're doing here, if you like this video, be sure to share this on your social media accounts. Hit that like or subscribe button. And I look forward to seeing you back in one of my next videos. Thanks. Have a great day.